part A, calculate the expected break-even point in units for each chocolate produced for the year ended 31 October 2020. You should ignore the special order and the possibility of RCL establishing their own retail division in this part of the required. Alright, so we need to calculate the break-even point in units for each chocolate produced. So guys, I recommend that you start by writing out the formula, and once you have the formula, you'll then see what other calculations are necessary. So how do we calculate the break-even point in units? We take total fixed costs and we divide by the contribution per unit. However, when the company sells more than one product, we divide by the weighted contribution per unit. So we know in this scenario over here, we have a company that sells 4 different chocolates: the milk chocolate, the dark chocolate, the white chocolate, and the top deck chocolate. So we need to divide by the weighted contribution per unit. So please note, even though the required wants you to calculate the break-even point in units for each chocolate produced, first we perform this calculation in total. We calculate the total break-even point for all products. Then after we have the total break-even point, using the sales mix, we split that between the different products. So please note, you are not performing 4 different break-even calculations over here. You perform one calculation for the company as a whole, and then using the sales mix, we split that between the different products. Then, something or a question that I've been asked quite a lot, guys, during this exam revision period that I just want to address up front. Please note, don't get confused. If you go back to the information provided in the scenario, we have inventory for 2 of their products. Okay, we know for the white chocolate and the top deck chocolate, they don't hold any inventory. However, for milk chocolate and for dark chocolate, there is opening inventory over here. Now, some students are getting confused as to or what they should do with these inventory balances when calculating the break-even point. Please remember, guys, when we are calculating the break-even point, the assumption that we make is that the sales mix remains constant. So you never look at production units, you never look at opening or closing inventory. We only ever look at sales units when we are calculating the break-even point. So please don't overcomplicate the calculation. You don't include opening and closing inventory in the calculation of break-even point. Don't make that mistake, guys. We use the sales mix. We look at sales units. Ignore production units, ignore inventory balances. Okay, we only work with sales. So now up front, before we can calculate the break-even point, we're going to have to calculate a weighted contribution. We've already said we need a weighted contribution per unit. And we are going to calculate this weighted contribution over here using the sales mix. Because the assumption that we make is the sales mix will remain constant when a company sells more than one product. So for 2 of the products, for the milk chocolate and for the dark chocolate, you have been given their forecast sales. However, for the white chocolate and the top deck chocolate, we have not been given their forecast sales. So we are going to have to work backwards in order to calculate what the forecast sales are for white chocolate and for top deck chocolate. Now, what you needed to identify is the fact that you've been told that white chocolate is 10% of total sales. So once we know what the total sales are, 10% of that is white chocolate. And you are also told that milk chocolate is 40% of total sales. Now, this is the link that you needed to identify. We know that they expect to sell 800,000 units of milk chocolate during the next financial year. And you've now been specifically told that that is 40% of total sales. So using that, we can work backwards to calculate what total sales are for all 4 products. So let's start with that calculation. All right, if we are trying to calculate total sales, we know that for milk chocolate, they expect to sell 800,000 units. And we know that that's 40% of total sales. So guys, remember the logic is you multiply by what you want and you divide by what you've got. We are trying to calculate total sales or 100% of sales. So I'm going to multiply by 100. I want 100% total sales. Divide by what you've got. The 800,000 is 40% of total sales. So that means they expect during the next financial year that they will sell 2 million chocolates in total. Now we can look at the breakdown. We know that milk chocolate is 800,000 units. We were also told that dark chocolate is 400,000 units and white chocolate is 10% of total sales. So now that we know total sales are 2 million units, we can calculate the number of units that they expect to sell of white chocolate. Okay, so dark chocolate is 400,000 units. And you are using sales units, guys, not production units. Don't make that mistake. Okay, white chocolate is 10% of total sales. So total sales are 2 million units. So 10% of that is 200,000 units. And we know that they also sell top deck chocolate. So guys, this is obviously going to be your balancing figure because we know that the total is 2 million units. So work backwards and calculate how many units of top deck chocolate they expect to sell. So your balancing figure over there is 600,000 units. All right, so calculate all of these as a percentage so we know what their sales mix looks like. So 40% of sales will be milk chocolate, and you obviously told that that's 40%, but you can prove the calculation by saying 800,000 divided by 2 million. That will give you 40%. Then perform the same calculation for dark chocolate. 400,000 divided by 2 million is going to give you 20%. White chocolate we know is 10%. And for top deck chocolate, 600,000 divided by 2 million is going to give you 30%. So that is the sales mix. That is the sales mix that we are going to use to calculate the weighted contribution per unit. And it's also the sales mix that we are going to use right at the end. After we've calculated the break-even point for the company as a whole, we are then going to use the sales mix to split it between the 4 different products, because in the required, you are specifically told to calculate the break-even point in unit for each chocolate produced. So not just the break-even point in total, but for each chocolate. So we'll use that sales mix to split the break-even point between the 4 different chocolates. Okay, so that calculation you obviously needed to perform up front. Then we need to calculate total fixed costs and we need to calculate the weighted contribution per unit. So let's start with total fixed costs. So the fixed costs that we were provided with in this question, first we have the fixed manufacturing overheads. So you can just include that in your calculation directly, 3,823,000 Rand. All right, all of the other product costs on this page were all variable costs. So we'll take those into account when we calculate the contribution per unit. You can ignore them for now. We then had period costs. Sales, marketing, and distribution costs we said was a variable cost, so ignore that for now. We'll look at it when we're calculating the contribution per unit. However, for the admin costs, we now need to determine whether these admin costs are variable or semi-variable. Because obviously if it's a variable cost, we'll ignore them for now and only take it into account when we calculate the contribution per unit, On the other hand, if it's a semi-variable cost, then there's going to be a fixed portion and a variable portion. And we need that fixed portion when we are calculating total fixed costs, obviously. So let's now determine if we are dealing with a variable cost over here or a semi-variable cost. So I said to you, it's definitely not a fixed cost because you can see when your sales volume increases, the cost increases from 2.5 million to 2.82 million. So if it's a fixed cost, then obviously it won't change with a change in sales volume. So the fact that it's changing means it's not a fixed cost. Is it potentially a variable cost? Now, the way that you're going to determine whether this is a variable cost is calculate the cost per unit. Because if we have a constant cost per unit, then it's going to be a variable cost. So, admin costs are expected to be 2.5 million rand per annum. And that is based on them selling how many units, guys? We've now performed the calculation. They expect to sell 2 million units in total during the next financial year. So please be careful. I intentionally tried to make this difficult, guys. You can't only be looking at the forecast sales for milk and dark chocolate. You need to look at the forecast sales for all products because you've been provided with their admin costs in total. So obviously this admin cost doesn't only relate to milk chocolate and dark chocolate, it relates to all products. Unless you're specifically told that the admin cost only relates to specific products, it makes sense that this is the admin cost for all products that they are going to produce. So if we are trying to calculate the cost per unit, you're going to take this 2.5 million rand in total and you are going to divide by 2 million units and calculate the cost per unit. Okay, so this is going to give us 1.25 Rand per unit. Then, if the sales volumes increase by 20%, so sales volumes are currently expected to be 2 million units. If that increases by 20%, they will then sell 2.4 million units. And then the cost will increase to 2,820,000 Rand. So if we now divide that by 2.4 million units, that gives us a unit cost of 1.175. All right. Now, this is just a rough calculation so that we can determine whether this is a variable cost. Because remember, guys, the logic is your variable cost per unit will remain constant. The cost in total will change with the change in sales volume. However, the unit cost will remain constant. So the fact that this unit cost over here is not constant, the fact that it's different, means we are not dealing with a variable cost over here. So by process of elimination, we know that it's not a fixed cost, we know that it's not a variable cost, and therefore we are dealing with a semi-variable cost. So what we need to do is we need to split the semi-variable cost into its fixed and variable portions. So let's just tidy this up. We don't need that calculation for anything else. So how are we going to split the semi-variable cost into the fixed and variable portions? And please remember, guys, you need to do this. We can't work with semi-variable costs. Where do you put semi-variable costs in your formula over here? There's no space in your formula for semi-variable costs. We can only work with fixed costs and variable costs. So if you have a semi-variable cost, you must always split it into the fixed and variable portions. So how are we going to do that in this question? Well, guys, we know that if they sell 2 million units, the admin cost will be 2.5 million Rand per annum. On the other hand, if they sell 2.4 million units, then the cost is going to increase to 2.82 million Rand. So we've got two different costs with two different sales levels, meaning we can use the high-low method to split this semi-variable cost into its fixed and variable portions. So let's have a look at that calculation now. So just leave some space over here because obviously the fixed portion of the admin costs, our fixed admin costs, will need to be taken into account in that calculation. And whilst I'm here, guys, another common mistake that's made, please, don't make this mistake either. is often you only want to take production or manufacturing related costs into account when you're calculating the break-even point. Think about this logically, guys. The break-even point is the point where the company does not make a profit or a loss. So you're thinking about your statement of profit or loss and other comprehensive income. Any expense that affects profit or loss needs to be taken into account in this calculation. So we don't only take product costs such as material, labor, and overheads into account, we also take period costs such as selling, marketing, distribution, and admin costs. All costs that affect profit and loss need to be taken into account in this calculation. So that's why when we are calculating the total fixed costs, we need to include fixed admin costs in the calculation. Please don't only include product costs in this calculation. That's completely incorrect. All right. So this is now going to be calculation 3, and we are now going to split those admin costs into the fixed and variable portions. Okay, using the high-low method. All right, so the admin cost is going to be 2.5 million rand if they sell 2 million units, and it will increase to 2,820,000 rand if the sales volume increases by 20%. Okay, to 2.4 million units. So calculate the difference in cost and the difference in sales volume. Then remember, we calculate the variable cost by taking the difference in cost and dividing by the difference in sales volume. So the variable cost is 80 cents per unit. Then the fixed cost is going to be the balance. So if we are trying to calculate the fixed cost, we take the total cost and we deduct the variable portion, and that will leave us with the fixed portion. Now you can either perform this calculation using the high information or the low information. So in my suggested solution, I used the high information. So now I'm going to use the low information just to prove to you that both work. Obviously, don't perform both calculations. Pick one. Both of them will give you exactly the same answer. So using the low information, the total cost is 2.5 million. The variable cost we calculated to be 80 cents per unit. So just be careful. If you are using the low cost, then you also need to use the low sales volume when you are calculating the total variable cost. So we need to multiply that by 2 million units. So obviously if you use the high cost, then you also need to use the high number of units in your calculation. So that's going to give us a fixed cost of 900,000 rand. All right, so we've split the admin cost into its fixed and variable portions. Let's just include the fixed cost in our calculation above. And then those are the only fixed costs that we are dealing with in this question, so we can calculate a total over here. And we can then include that in the formula above. Then next we need to calculate, that can't be calculation 3. We've already had calculation 3 for the admin costs. So this is now going to be calculation 4, where we look at the weighted contribution per unit. All right. Now, guys, if you go back to the information provided in the scenario, you were given the contribution per unit for white chocolate and top deck chocolate. For white chocolate, it's expected to be R6.50 per unit, and for top deck chocolate, it's expected to be R8.50 per unit. So you don't need to calculate the contribution per unit for those chocolates because the information has been provided. However, you do need to calculate the contribution per unit for milk chocolate and for dark chocolate because we don't have that information. So how do we calculate the contribution per unit? We take the selling price per unit and we deduct all of the variable costs per unit. All right, so you have been given the budgeted sales price for both chocolates. It's R16 per unit for milk chocolate and R20 per unit for dark chocolate. Then we need to deduct all variable costs. So first we have the variable production or the variable manufacturing costs, which include direct material, direct labor, and packaging. And this is very simple because you have been given all of these variable costs per unit, so you can just transfer these amounts across to your calculation. Right, and then once again, don't forget about the period costs. We are calculating the break-even point, so all expenses that affect profit and loss need to be taken into account in this calculation. So we have sales, marketing, and distribution costs, which are 3% of turnover. Right, so we'll just have to look at a separate calculation over here. Okay, just 3% of turnover. So take the selling price per unit and multiply by 3%. Right, then lastly we have the variable portion of the admin cost that we calculated above, which is 80 cents per unit. All right, right, and you can then calculate the contribution per unit for each of these products. And we now have 4 different contributions per unit because we have 4 different products. So what we need to do is use the sales mix in order to calculate the weighted contribution per unit. So for milk chocolate, the contribution per unit is R7.12. And if we go back to the sales mix calculation, 40% of total sales will be milk chocolate. So we need to multiply that by 40%. Then for dark chocolate, the contribution per unit is R12.45. And we need to multiply that by 20%. For white chocolate, it's R6.50 per unit. And we need to multiply that by 10%. And for top deck, it is R8.50 per unit. And we need to multiply that by 30%. And that will give you the weighted contribution per unit. Please note, guys, you will see there is an alternative calculation on the suggested solution. You're welcome to use the alternative calculation. So the only difference is with the alternative is you first calculate contribution in total. So you take the contribution per unit for each of the products, you multiply by the sales volume. Remember, we look at the sales mix, so you use the sales volume. Don't look at production volume, don't look at inventory balances, use the sales volume. So take the contribution per unit, multiply by the sales volume, calculate contribution in total, and then divide by the total sales volume, which is obviously the 2 million units that we calculated above, and that will give you exactly the same answer. So you're welcome to also obviously perform the calculation in that way. Okay, it just depends on what works better for you. Okay, and we can now wrap this calculation up. Let's just check my referencing here is a little bit out. So this comes from calculation, sorry, I just want to make sure I've referenced all the calculations correctly. This comes from calculation 4, and this comes from calculation 4. And now, this is obviously calculation 6. Okay, so make sure you always reference your calculations correctly, guys. And always write down all of your calculations. Never perform a calculation using your calculator and not write down what you're actually doing. Okay, if you make a mistake, you lose all of those marks. All right. And then remember, when we are calculating the break-even point, we don't use normal rounding rules. So even if you use normal rounding rules here, you would still come back to the correct answer because obviously 0.5 would be rounded up. But even if your answer was 553,044.1, you still round up. Whenever you're calculating the break-even point in units, you need to round up to the nearest whole number, because if you round down, the company won't break even, but instead they'll actually make a small loss. So please make sure that you always round up. Okay, so we've calculated the break-even point in units for the company as a whole. We now need to use the sales mix to split that between the 4 different products. Okay, and to make sure that your rounding is correct, when you are performing this calculation, use the amount before you've rounded up to the nearest whole number. Okay, so for milk chocolate, we are going to multiply by 40%. For dark chocolate, we are going to multiply by 20%. For white chocolate by 10%. And for top deck chocolate by 30%. And in each of these calculations, round up to the nearest whole number. All right, and that then answers part A of the required.